of these policies in effect. So, what we started on last time was building the market for reserves. And all we did, we just drew the framework. We didn't even get to the curves here. So we're measuring interest rates up here of different sorts. And we've got the quantity of reserves in the system down here. And we've got multiple interest rates that we're going to be tracking with this. And the key one that we're looking at is the federal funds rate. So we're going to let little IFF equal the federal funds rate, which I think we defined last time, so I won't write it again if I remember right, didn't we? You have that in your notes? Yeah. So that was the interest rate that banks charge each other for short-term loans to meet reserve requirements. And so that's kind of an easy way for them to shore up their legal requirements is to take a quick loan from another bank rather than going to the Federal Reserve, which is another option. And then we've got a couple other rates that play into this analysis. The discount rate, I subscript D, which I think we also defined last time. Is that correct? So that is the rate that the Federal Reserve charges on discount loans. That is typically set above the federal funds rate so that the Federal Reserve gives a little incentive for banks to just loan money to each other when they need to. And it's kind of interesting why they do that. The Federal Reserve would rather have the banks monitor each other to some degree. How does that work? What do you mean? What do they mean by that? So one of the incentives to having, let me just write this out here. Note, ID, the discount rate is usually greater than the federal funds rate. Remember that ID is set by the Fed. And one of the reasons is that the Fed prefers to have banks monitor each other. And let me put to some degree, I guess, would be a fair statement. How do we get that out of having the discount rate greater than the federal funds rate? What are they getting at? What's the connection here?
It incentivizes the banks to borrow from each other instead of relying on the Federal Reserve as much.
Okay, yes. And then why would the monitoring part come in? How does that, that doesn't seem immediately obvious to me. What type of monitoring is going on? Okay, whether they're taking out risky loans. So when we go to get a loan for ourselves, for our house or a car or something, what does the bank do? For you guys, what do they do, Reno? Check your credit, check your income, go through the whole loan application process, right? Because they want to make sure that they're not just handing money over to a loser who's not going to pay it back in a month and not even make their first payment, right? So that's what they're doing here. By having the banks loan to each other, it's still, they're taking on risk. Those loans aren't FDIC approved. So they have incentive to make sure that one bank's not loaning to another bank that's a loser. So they are providing financial statements back and forth to each other. They're like going through loan application process with each other. They're having a dialogue with each other to make sure that they're healthy. So when Chase Manhattan goes to HBC, they were just on the news this morning, but now I'm losing their acronym. When Chase goes to Wells Fargo to get a loan, they know that, hey, Chase says, look, here's our financials, we're in good shape, we just need a little loan tonight, right? And they say, oh yeah, that looks good. Okay, so they're always kind of double checking each other And that takes a little less heat off of the Fed to be the one that's always monitoring every little thing. So it's kind of a cool way that we're letting the market system do some of the monitoring on its own, right? Shifting the burden into the private sector, letting the free hand, the invisible hand of the free market, do a little bit of that monitoring all by itself by letting that go. Not completely stepping away from the whole picture, bear in mind, but having this mechanism to allow them to do some checks and balances internally. Okay, so that's the federal funds rate. Then our new one is IOR, which is, I had to look, your book does not specifically say it actually. It's interest on reserves is what the O stands for, even though they don't technically say it. I combed through the book just to make sure that that's what the O meant, and that's all I came up with, is that that's exactly what it is. So interest on reserves. So the Federal Reserve pays interest. The Fed let me make this full comment here. Started paying interest on reserves in 2008. They had been asking to pay interest on reserves. They had brought this topic up for the last 10 years. And it finally got in the pipeline to get put into place in 2011. But they accelerated that. Why? What happened around 2008? That's our financial crisis time frame. So they got this put into place as one of the many things that they threw on the fire, one of the many buckets of water that they tried throwing on the fire on the financial crisis. Bernanke accelerated the change in policy from 2011 to 2008. And so now they're paying interest on reserves. So that means all money potentially has the ability to get some interest on it. Yeah?
So if they accelerated it to 2008, how is that helping the whole monetary policy inject, like money supply issue of people holding reserves versus holding not?
Yeah, let me hold on. It's on the required reserves, I guess is maybe the short answer, but that's kind of what we're going to work on. Yeah, so it's actually on the required reserves too. All right, so those are the three interest rates that we have. And I think before we draw a supply and demand curve here, which are some of the weirdest supply and demand curves I've ever drawn, by the way, so this is where it gets kind of fun, is we've got the discount rate is the top dog, the higher interest rate. The federal funds rate is the middle. This is our kind of initial starting place. And then the interest on reserves is typically the lowest. So that's, you can just kind of evenly space them along the vertical axis. And why is the discount rate at the top of the heap? What are some financial reasons that we'd expect that to be high?
We're looking at the perspective of the bank. IOR is going to be the interest rate that they receive versus IB being the interest rate that they pay. So it's kind of just like a bank situation, whereas IOR would represent your savings account and everything else, but IB would represent the loan interest rate if you were a normal consumer.
Okay, other comments? So what is the discount rate used for? Who gets those loans? What kind of banks and what kind of situation gets discount rate loans? Melissa? in emergency situations, right? When they're in trouble. So what's the risk associated with those type of loans? Higher or lower? Higher, right? And so we have that risk-reward trade-off too that's playing into the picture. And I think, Michael, tell me if I'm hearing you right. If you are taking out one of those loans, you're still getting this, but you're paying this, so that we're leaving it in a. If you're a bank that's taking out one of those loans, you still have to have some reserves on hand for your deposits. We don't want that to be an advantageous situation. Is that kind of what I heard?
No.
Okay. What were you saying?
I was just saying.
Because I'm not sure you're right then.
If you take it to the perspective of the consumer, so say you go to People's Bank
Mm-hmm.
and you put money in a savings account, that's IOR. Like that's kind of the equivalent of IOR. Whereas the banks put money into the Fed and they receive a small
Okay.
interest rate on it. And then say you go to People's Bank and you take out a loan, obviously that loan interest rate is going to be higher than whatever you put in your savings account. Whereas
So they're borrowing it from themselves. If they put this loan, if they're like the consumer, but then they go out and get a loan, they get a loan at a higher rate. Okay, that's kind of what I was trying to restate, but why don't we talk after class? I'd like to hear where you're coming from, but I don't want to spend more time on it now. All right, so what's it, Reno? Okay, why don't you restate it for me?
I don't know. Like,
I mean, I was tracking with you on the.
I thought you said it pretty well. Just like,
it's
if
just like
you're saying that bank is just like an everyday consumer.
Yeah, they got their money on deposit with the Fed. I was following you there. Yep.
And that's like you take out a car loan. You know that car loan is gonna have a higher interest rate than your savings account. It's the interest you're making on your savings account.
Right.
Is what it's for.
But and what I was saying is it's kind of like borrowing from yourself. If you actually put the money at a bank and then 6%, it's kind of like you're borrowing from yourself.
I mean, if
You're paying, so your difference is the 4. Is that what
I
you're saying?
understand that. I was just saying, not necessarily even going there, just saying that ID is higher because that's your borrow rate.
That's your borrowing rate.
IOR is your rate.
And that's the spread, right, for the Fed. Yeah. Okay, good. So what does this look like then for the supply curve and the demand curve? That's the next piece we want to think about. So the normal situation would be a fixed amount of, and I want to draw this carefully, kind of watch me draw this first of all, a fixed amount of reserves, and I'm going to kind of cheat and just say that this is where the federal funds rate are. This would be kind of our normal supply demand for reserves. So these are banks that are looking to borrow from each other some amount of reserves. So from the Fed's perspective, that is what we're going to call non-borrowed reserves because they're not borrowing from the Fed. They're borrowing from each other. So that's kind of the market response. Okay, so then where it gets a little funny is at these endpoints. So would the federal funds rate ever fall below the interest that the Fed was paying on reserves? So in other words, would banks loan something less than what the Fed was willing to pay on loans? So if the supply changed, if this kind of started drifting out, if there was an increase in supply, the federal funds rate would start to fall. Would those people supplying funds to the market want to supply them to banks when rates were low, or would they just supply them to the Federal Reserve at the rate that they could get on reserves? Who would they go to? So the suppliers, remember, are private banks. And where's my golf club? That's why I knew that. This one might come in handy here. So everybody with me, first of all, that as banks' reserves start to increase, there's an increase in the supply. These are private banks supplying reserves. an increase in supply causes the federal funds rate to fall, right? And so if it was to shift way out here, then the market rate would drop to here. But those banks have the option of depositing with the Fed. Would they take the Fed's deal? Yes, because it's a higher rate, right? So what ends up effectively altering the demand curve here is this flattens out at IOR. So the reserve demand curve, RD, R subscript D, has got this elbow shape at the interest on reserves. So again, banks will gladly supply their funds to Chase Manhattan. As the interest rate starts to fall, though, eventually it's better off for them just to deposit it with the Fed and get that higher rate. They're not going to continue to fall. Okay. Now, the upper bound has some interesting implications as well. If the Fed, one of the things we'll write down later, if the Fed increases the reserve requirement, then banks are going to demand more reserves. They need to have more on hand. If the Fed raises the reserve requirement from 10% to 20%, all of a sudden the banks are like, oh crap, I got to go borrow some funds to make my reserve requirement, right? So that's going to increase the demand for funds, which will put upward pressure on the federal funds rate. But will we ever get to the point where the federal funds rate exceeds the discount rate? The answer is no. They'll start to go to the Fed to borrow those funds that they need. And so this has an elbow at the discount rate. And so the reserve supply curve is funky looking like this. Remember that the interest on reserves as well as the discount rate are both set by the Fed. These are two policy instruments. These are both set by the Fed. So they can raise or lower the discount rate. They can raise or lower the interest on reserves. And then you'll see these changing as well, these upper and lower bounds. And so this starts to get into this idea of federal fund targeting. If they want to keep the federal funds rate in this range, they can kind of force it to be in that range by keeping fixed these upper and lower bounds now. Okay? Questions there on the setup? All right, so now we got to work through some shifts. So, on example number 1, I guess, an open market purchase. An open market purchase. Okay, so what's going to happen to reserves? Are we talking about the supply of reserves or the demand for reserves? Reserves are kind of this nebulous thing again. So let me think back to the monetary base. What was the monetary base? Currency plus reserves, right? Currency plus reserves in the system. So what happens here with reserves? Is there more demanded or more supplied with an open market purchase? Supply, good. So an open market purchase is going to lead to an increase in the supply of reserves once we start to get the money into the system. And so that's going to cause an increase in reserve supply. So we're going to have open market purchase leads to an increase in RS, a shift to the right. But we're going to have two cases we need to look at. Two cases. Case one, and I'm going to try to squeeze case two. So we're going to put two graphs kind of side by side, so you can just leave enough room on your paper to do that. And case one, I just want to replicate what we got here. So kind of our home base is the federal funds rate in the middle, so you can start to try to draw your graph with RS and RD. If you want to put dash lines or whatever, you can. The intersection of the two tells us our current federal funds rate, IFF1. So with a shift to the right, we're going to take this thing and move it to the right with the supply. And we'll start to see a decrease. I'm going to use the blue. Now this guy here, since the discount rate was unchanged, just kind of slides into itself, right? So we kind of have RS2 looking like that. And our prediction is that the federal funds rate falls. So this is flowing with our other analysis we did before with the money market, and thinking that if there is an open market purchase, that causes an increase in the money supply. Money supply shifts to the right, interest rates fall. So there is some parallels going on with what we did before with this. All right, so then case two, we're going to be starting off at that lower bound and see how things change. So start off, oops, got this one open. So start off now with the intersection. These don't have to correlate, by the way, with interest rate. You don't have to make these all line up nice and nice. So you can draw a new one if you want. And I kind of maybe would have drawn that a little bit further over, but it doesn't really matter. So RD and RS. Have it so that it's intersecting at that lower bound. Now, it's not that the federal funds rate disappears. It's just that since there's another player there, there's no incentive for them to change the federal funds rate different from what the interest on reserves is. So the federal funds rate will effectively be the interest on reserves. Yes?
So if supply goes up to that point, it flattens out like that because the Federal Reserve has that interest on reserves, which means banks don't have any incentive to lend to each other if they can get better money putting it in with the Fed.
Right.
So in that case, what do banks that need to do their overnight borrowing do? Do they have to just go for a short-term discount rate, or? They'll borrow at the federal funds rate. The federal funds rate will be the interest on reserves, though. So those two numbers will be one and the same. So if this is a 0.5%, this will be 0.5%. Okay, and so
then we'll end up effectively leaving the borrower of the funds indifferent between going to a bank for it or going to the Fed for it,
All right.
once it hits that lower bound. Okay, so if you haven't shifted already, we still have an open market purchase going on, similar to quantitative easing perhaps. And so we have the blue curve shifting over and the federal funds rate being unaffected by that.
I have a question.
Yeah.
If the federal funds rate and the OR are the same, then would banks start just putting more money into the Federal Reserve rather than letting other banks for it?
They might, but I think there's still going to be a reluctance on their part to do that if they don't have to, if other banks are still offering that lower bound. But they're not willing to do it enough so that they're only going to get something less. Then they're like, no, it's not worth it that much.
At the same price, they're still
Yeah.
one of the other things.
Yeah. Okay, so, and then I think that'll become a little more clear when we get into some of the other shifters. But so this is how our lower bound ends up being, and something very similar to what we've observed in the real world here during the financial crisis, that we've continued to have quantitative easing and open market purchases, and we've seen the federal funds rate effectively being set by the Fed. If the Fed, I don't know if this is a good time to do it or not, I think we'll maybe save it, but if the Fed lowers the interest on reserves, then the federal funds rate will lower too. So they kind of effectively, once we've hit that lower bound, they're kind of in control of the federal funds rate. All right, any other questions there? Let's look at the discount rate next. So example number 2 is Fed lowers discount rate. A decrease in ID. Expansionary or contractionary monetary policy, lowering the discount rate. Expansionary, good. So they're lowering interest rates, and we're going to have a case 1, case 2 again. So hopefully one of my objectives here is to get you good at drawing these new crazy graphs. So if we are at the regular intersection point, and we're up here at ID, and down here at IOR. So there's our home base. This is the quantity of non-borrowed reserves. What is the impact of a lowering of the discount rate here on the federal funds rate?
Doesn't it just shorten?
Yep. Drop the ceiling, right? So all of a sudden this thing's going to drop, and what's the impact on the federal funds rate? Nothing. Yeah, so there's no shifting going on this way. So it's kind of like when, we had a, if the market rate for, okay, I guess that means we get to take a little break. let the book burn.
You let the book
But I don't want these notes to burn. These are more, there's a lot more work to this.
Oh, it's so loud.
You're on, oh, that's true, yeah, okay. So you wouldn't see you coming in and out necessarily all the time.
It's a pretty bad move.
Okay, and we're back. No, I'm just erasing this board so I can come back to it and dirty it up again. Thought I would save one trip. Okay, so yes, we shortened the stem. And the new discount rate, ID2, just makes the stem shrink down. So RS2 looks like that, which leaves our federal funds rate untouched. Okay, now the more interesting case here, case 2.
Discount rate goes below or at the federal.
What's that?
There's whenever it goes below or is at the federal funds rate.
Right, yep. So that's our case 2, as if we're in a different world for a starting place. And we are at the downward sloping part of our elbow. Like that. If this board is just a little bit wider, it'd be just perfect. So now we've got the federal funds rate is currently pinned at the upper bound. Now, one other little thing that is going on here, the amount of non-borrowed reserves is still at this vertical line. But now that we're at the upper bound, what's going on here? Yes, that extra chunk, right? Just the extra chunk is the amount borrowed. So this amount, this horizontal distance, is the borrowed reserves. And we lower the discount rate. And the federal funds rate comes down along with it. The supply of funds by private hands were still exhausted, so the bump up just caused more borrowed reserves. The Fed's lending increased. All right, questions on that one? Yes. So, let me write it here just to give myself a little bit of room, I guess. So, and you want for case 2, right? For 2, the discount rate equals the federal funds rate, which means a lowering of the discount rate will lead to more borrowing from the Fed. And this is our little BR, an increase in BR.
So will eventually the federal fund rate kind of correct itself and drop back to the
So if we're here,
yeah, like how it, you know, how it started out, you know, the discount rate, the federal fund rate.
right?
And then
Yep.
and then so they lower the discount rate, will eventually the federal fund rate lower again, so it's lower.
What would need to happen for that to go on?
The
So you're thinking good, I mean, you're thinking right, Rena. So basically what market forces, let's say the Fed does nothing, right? So the Fed just keeps it, let's just leave it at this new lowered amount, ID2. Demand goes down. So if reserve demand comes down, we could start to be operating back into this range again. Yep. So if there's a decrease in the demand for reserves, or if there's a increase in the supply of reserves, which we just did before that I already erased, but if the Fed does an open market purchase and injects more reserves into the system, then there's going to be more reserves here, and that's going to cause us to possibly go down. Yeah. And the blue line stays the same. As reserve supply increases, then it'll come back and the Federal Reserve's federal funds rate would drop down. And so that kind of highlights how open market purchases kind of are important. If they do an open market purchase and change the reserves, the supply of reserves in the system, then they can alter the federal funds rate. But they don't control the federal funds rate, because then there's other factors at play that might change the quantity of reserves on top of what the Fed does. But the Fed can keep increasing those reserves. This direction is easy for the Fed to go, because open market purchases, they can always print money. So remember, when they're buying, they're giving currency into the system. Well, they have the luxury of running the printing press. But when they need to put it in reverse is where sometimes banks have problems, because now we're limited by the amount of bonds that we actually hold. Because with an open market sale, I have the bond and I'm selling it, but it's a government bond or whatever, right? It's not a federal bond, so they're putting the bonds back in the market, and so whatever their portfolio, whatever their balance sheet is with the quantity of bonds, that's kind of the limit for them sucking stuff out of the system, sucking reserves out of the system through that mechanism of open market operations. Okay, good. Anything else there? All right. Reserve requirements. So, change in example number 3. We are going to increase RR. An increase in the required reserves. So we'll start in our middle section here. Federal funds rate, discount rate, interest on reserves. If the Fed requires banks to hold more reserves, what happens? Reserve demand goes up. Anything happen with this little elbow? No. So reserve demand shifts to the right. Nothing happens on this stretch, or you can think of it shifting, but it really doesn't go anywhere. And so RD2 looks like that. And that causes upward pressure on the federal funds rate to raise from 1 to 2. Okay, we'll call it a day there. A little shortened time with our fun fire alarm.
Yeah.
That it might go off again once we got in
No,
here?
no, like, once it started, it was like,
Oh.
let's give you a couple seconds to keep reading.
Bye.
Oh, yeah, I figured.
Oh, I was kind of going to mention that Wednesday is the Fed tour, but hopefully everybody's got that on their radar, I think. But I was at least going to verbalize it at some point.
What exactly should you wear?
Well, don't make yourself look like somebody